I'm Mark Gagan, and you're listening to a special episode of the Voice of Insurance podcast, produced in association with Stevens Rickard. This is the third instalment of the podcast, where I use the annual Monte Carlo RendezVous to gauge the outlook ahead of the key 1/1 treaty renewals. This year, a lot had changed in the preceding 12 months. 2023 results had been almost universally excellent for all reinsurers, and capital had returned to very healthy levels. Colour and confidence were visibly returning to the market. Smiles and receptive ears were in far greater supply than a year previously, and the grim mood of 2 years ago had been almost completely forgotten. The only flies in the ointment were continued emergence of poor back-year performance in some US casualty classes, and a hesitancy among investors, who still seemed more ready to punish any bad news than reward the good. Whatever had been black and white 2 years ago was becoming progressively greyer, and choice and options over what and how and in what shape or size reinsurance could be bought were beginning to open up for cedants. In short, this was a market of nuances, and one where experienced traders were going to be given an opportunity to shine. So join me as I root them out from either side of the underwriting desk and find out what's going on. My promise to you is that if you weren't lucky enough to be down on the Côte d'Azur in early September, listening to this podcast will be the next best thing to having been there in person, in the rooms, suites, cafes, restaurants and lobbies with me as I interrogate a large number of key industry personnel. Give me the next hour and I'll give you the state of reinsurance. So let's get started. Let's hear from James Vickers, Chairman of Gallagher Re International, to set the scene. As always, I started by asking him how he would describe the state of the reinsurance market.
It's in an interesting position at the moment. I think a lot of people have used the word equilibrium. I'm not sure that's quite right. Reinsurers are obviously coming to Monte Carlo off the back of a very, very strong 2023 result and a very good half-year result. They're looking to maintain that, but they're also looking to grow. The growth agenda is a very big issue.
So in terms of equilibrium, can everyone grow and there still be equilibrium?
Well, there you go. In one. At the same time, we've also got buyers who... They've had a tough couple of years. They've had to bear not only increased prices, but restructuring, increased retentions. And they are questioning the value of what they've been buying. And at the same time, they're looking at the reinsurers' results, which are, to be honest, pretty spectacular and considerably better than their own results, and are looking for something back in return. And the question, I think, for the reinsurers is, how can they manage that sort of knife edge of getting some growth, maybe not as much as they had in 2024 and 2023, without giving away too much in terms and conditions?
James is great at summarising, and this, in broad terms, sets the subject line for the rest of this documentary. We'll find differing opinions and some dissenting voices, but I think James has it. It's time to hear from some reinsurers. First, Alex Maloney, CEO of Lancashire, and then John Welch, Aspen's CEO for Reinsurance.
I think the state of the reinsurance market is good. I think everyone's quite happy with their Monte Carlo. Most people are making good money. So, yeah, I think it's a positive Monte Carlo and most people are happy.
Mark, I describe it as balanced. I think I'm already seeing that, although it's early in the conference, that there's kind of a reasonable range around expectations of what the market is going to do in terms of pricing. I think for the most part, when we look at the market, we think pretty much most lines of business, most regions are profitable. We've grown quite a bit during 2024. We expect to continue some of that growth into 25. So we think it's going to continue to be attractive and a well-priced market.
And now a quick check-in with Jill Beggs, Everest's COO of Reinsurance. To summarise, you're reasonably happy and it's a time for measured growth. Is that fair?
I think it's fair. Everest has a global diversified portfolio, and we think that that's an advantage, and we've got the strength to meet the moment in this ever-evolving marketplace. So we're feeling very positive about where we're at overall.
I think now is the time to bring in Charlie Goldie, CEO of MS Re.
I think for me, Mark, no real surprises. The market is still recovering from the soft market years. Different companies are at different stages of where they are. And I do think most reinsurers at this point have gotten comfortable that most of the market provides a pretty attractive return at this point. People talk a lot about casualty. There's some other segments that have some concern, but overall reinsurers are happy with where the market is, but I don't think there's any thought that they want it to go down at all. When I talk to my own board, they say, we like the business, we like what you're doing, go ahead and grow. But I don't feel comfortable going back to them and saying, I grew 10%, and on the cover of the Insider or the Insurer, it says market down 10%. That's a work on my CV moment.
So there's relative happiness and confidence, but there's also that uneasiness that James Vickers mentioned at the beginning. Experienced traders like Charlie know that if you want something, you often have to give something in return in order to get it. But at least for now, being the first to break ranks might still seem like a sackable offence. But clearly, competitive pressures are building. But what sort of competition? Here's Waleed Jabshir, CEO of IGI.
All in all, I think it's still a very attractive environment, a very stable environment. All signs pointing to more discipline, really, over a longer period than previous hard markets. The bright spot here is that you've not got new capital coming in. And that is normally the driver behind new startups wanting their own piece of the pie. And that's what usually drives the more intense competition. What you're seeing now is just existing capital looking to be deployed following a very successful 2023 and wanting a bigger piece of the pie. I think that type of competition is different. And I think that type of competition, whilst will put a little bit of pressure on conditions and activity, that type of competition will be a lot more disciplined. So all in all, positive outlook overall, and I think a more stable environment for reinsurers and buyers going forward.
We'll be making our usual quick rounds of the potential for new capital and startups later on. But as Waleed is both a buyer and seller of reinsurance, his view of more competition, but generally disciplined competition, is interesting. Here's a fellow buyer and seller, James Slaughter, Group CEO of Lloyd's carrier Apollo, echoing Waleed's sentiments.
We haven't seen this huge influx of capital, neither have we seen a huge outflow of capital. Capital's quite rational. In fact, I think in the last two renewals, capital's been very rational. It's available if the rate was there and the product needed it, and if it wasn't, it's broadly stayed on the sidelines. That's not what happened in previous cycles, as we know. And I think that's an analogy that when I look at it from my lens, which is mostly through insurance lens, I'm very excited that the insurance industry will start to migrate towards a more data-driven consensus, because at the moment, I think the insurance market in particular has the potential to throw itself off the proverbial cliff somewhat.
It's less likely to do that on the back of naive and cheap reinsurance.
Yeah, that feels like an impossibility. I think you've got a huge responsibility to your customers and your stakeholders to make sure that the capital's there when you need it. And I think we've seen the reinsurance capital base is very stable. It's pretty sophisticated. There's less opportunity to find that person that is going to take that journey with you, and then you find out they actually don't have the capital, or it's less liquid than you thought.
So capital is rational, and so presumably will be any competition that does emerge. Here's a little more detail on this theme from James.
Today, everyone's got sophisticated tools. Regulators expect you to have them. The standards have risen dramatically. The quality of data is vastly improved. I think it's actually, from a buyer-seller perspective, from a deal-making perspective, much easier to reach consensus, because
you can already work out what their price is going to be, and you can understand that they can't really budge from that because they do need a margin. They have to service that capital, and you need that capital to back you as well.
Yeah, so no one begrudges people making money, because that's, in the end, we've got to build a sustainable growing capital base to support the risks of the industries and customers we support. I think that, therefore, makes it more rational. So whether it's a peak or a trough, those peaks and troughs are less obvious and less extreme. And so that stability, I think, has shown through quite clearly in the last 3 to 5 years.
This episode is supported by Stevens Rickard. Stevens Rickard Limited is an executive search firm with offices in London, Miami and Zurich, and a specific focus on the global insurance and reinsurance markets. Their deep appreciation for the markets they operate in, assessment methodology and exceptional track record of completion really sets them apart. The team's dedication to searching beyond the obvious, the D&I synopsis reports they produce, and their obsession with doing the right thing by both clients and candidates is demonstrative of their enthusiasm for improving the businesses of their clients and the careers of their candidates. To find out more, head to stevensrickard.com. Let's hear from some more brokers and see if we can find some other views. First, here's Peter Wilkie, who is Specialty Lead at BMS Re.
It feels like it's still relatively solid. We're in a period that you might describe as a fragile equilibrium, in that buyers are moderately happy in some areas, probably wanting to buy more limit, potentially challenging pricing, potentially challenging terms and conditions. On the other side, we've got sellers who are in a very good position, and they've driven some really high profits in the last few years, so they want to hold their position. I think that stability really depends on what happens in the coming months.
So, an echo of the fragile equilibrium theme, and a first hint of potential pushback from cedants from Peter, with the usual caveat on loss experience at the end. Here's Craig Darling, EVP and head of Acroshaw Re's Florida office.
I think this is an inflection point year, certainly from a property perspective, but also from a casualty perspective. Property, as you know, there's been scenarios where if the season remains relatively docile, we think more capital will come in and be attracted to the marketplace because it'll be year-on-year profit margins will have been received. Casualty standpoint, there's obviously still concerns around reserving and pricing of that business segment. So in both cases, there is opportunity. Casualty, for those who have capacity, that will be opportunistic as that market will be a little bit more conservative and a little more challenged. Property perspective, it still looks like a very, very healthy market to trade in. And again, I think subject to what happens over the next 45 days, we'll see it's an inflection point for the global reinsurers. If the wind doesn't really blow, we think that there'll be some movement on rate and additional markets will come in. If there is additional storm activity over the next 45 days, well, I think that might kind of hold the line on participation and new capital coming in. Just a viewpoint on that.
That's the first mention of a potential inflection point from anyone so far. And unsurprisingly, we're going to have a whole segment on casualty later. Back to reinsurers. On this inflection point question, I asked John Welch if we were past the peak of the last 2 years, and this is what he had to say.
I would say the peak profitability is probably behind us. So the profit margins, I think, have peaked. I think in many cases rates will continue to go up. Certainly the casualty area needs continued rate, and we'll watch very closely whether that rate is keeping up with loss trend.
If everybody wants to have a bigger share of the good stuff, does that mean that they might have to be a bit more pliant on terms and conditions and other things?
There'll be increased competition. I think so far, we'll see how the rest of the year goes. Most companies like Aspen will be growing their capital base. We've done a good job on the profitability side, which means there'll be more capacity to deploy and heighten competition.
John's the first carrier to say it here. Again, we need to separate casualty out, which we'll be doing later. Here's Martin Burke, CEO of Lloyd's player MS Amlin.
I suppose there's times when the tide comes in and all boats rise. And I think at this point, maybe it's the wrong analogy, but perhaps the tide is receding slightly. But
we're past high tide.
Yeah, but you essentially do have scope, or you do have work to do as a reinsurer. The work is to understand your clients, and it's to understand the work they've done on their portfolios and then how you actually make a difference to them.
There's Martin agreeing and bringing in a tidal analogy, as well as hinting at another big theme. Having passed the hot potato of increased property retentions onto cedants in the past 2 years and sat well above most losses, reinsurers have forced cedants to focus much more on how those inward books have been written. 2 years on, and some of those cedants that have been able to make big changes to the price and terms of their inwards book may be looking to get some credit from their reinsurers for all the good work that they've done. This is a question we're going to get into in some detail as this podcast goes on. About now, I'd say we're probably overdue a word with Howden's Head of Industry Analysis and Strategic Advisory, David Flandreau.
The thing is that the attachment points have risen to the point now where actually, I'm not going to say reinsurers are bulletproof, they're not, but if you look at the economic value add being generated by reinsurers, the returns on equity that they're bringing in and the combined ratios, and I understand one swallow does not a summer make. However, they are, if you equal weight them against many other indices, you'll see that they're creating lots of shareholder value, and that's great. And we want the reinsurance sector to be profitable and viable. We just think that in this environment, with attachments where they are, and with pricing where there is room for everyone to win, including the cedants. And I think that if this is a long-term partnership, this is a time to help and to make your client happy because, let's face it, it's been a tough year, particularly for personal line cedants in the United States, but not least for European cedants with all the different things that have happened. And we're seeking that partnership, but we know that to get there, we have to build the product and the capacity.
So, who should the brokers be talking to when they're looking for partners willing to trade? Well, Alex Maloney of Lancashire seems to be on the right page.
If you're coming as a reinsurer, you're happy with the way things have gone, and you're looking to grow at 1-1, do you think you can do that by doing the same things that you did last year, or do you think you have to do a bit more, you have to be a little bit more accommodating?
You're going to have to work harder. Lots of people want to grow, and there's not an unlimited supply of people needing reinsurance. So it's going to become more about relationships. One thing that we've been talking to our clients about is deep relationships, cross-class reinsurance buyers, and whether you're buying reinsurance or selling reinsurance, people are much more sophisticated. So I think that relationships are going to become more important. The products you sell, cross-class, are going to be more important than they were last year. And that's just a function of where we are in the cycle.
So again, would you accept that if sometimes to get the things that you really want, you have to give some of the things that you didn't necessarily want so much, but try and give a small amount of the things you didn't want to give and get as much of the stuff you really want?
That's the skill, isn't it? I mean, the skill always is, can you maximize where your risk appetite really is and minimize other areas? And the great buyers of reinsurance are going to push you, aren't they? And they're brokers. So, yes, I think that's always where we are at this point of the cycle.
Yeah, and to clarify where we are in the cycle, to say we're just past the peak.
Yeah, I think our world is driven by results, good or bad, and the industry's results are good, albeit we are only 18 months into good results. We're still in peak hurricane season, so let's see what happens for the rest of the year. But subject no large losses materialising, it feels like the peak.
That was an enjoyable exchange. It looks like we're really getting somewhere, with the realisation that if you want to grow, you're going to have to start trading a little more. It's time to bring in Sean Sanaya, Miller's head of reinsurance and capital.
I think reinsurers have a number of levers that they can pull. One is their participation across programs and across regions and having a holistic relationship with the cedant. I think that will hold them in better stead. I think also, and I think we're a big proponent of this, Miller is listening to what the cedant is actually saying and what's important to them. Is it that retention point moving? Is it the overall price of the program? Or actually are there in-betweens, such as expanding our coverages and looking at how we can tailor-make the best solution for the clients?
So if 2 years ago we were talking about reinsurance as a one-size-fits-all, now we can see that an element of choice may be coming back to buyers. Sean mentions bespoke, and here's Charlie Goldie developing the theme a little.
I think it really creates a really strange dynamic that is sort of unique to our business with the subscription market. And I think you're exactly right. Most reinsurers are probably happy to grow at current terms. And I imagine most are going to get hit over the head if they grow at something meaningfully worse than current terms, which creates this situation for the brokers where you're 70% placed, you're 70% placed, you're 70% placed, you're 130% placed. And once a buyer is willing to meet the market clearing price, they're going to have a lot of choice in who they do business with. But I think you're probably going to have to meet a market clearing price that's pretty close to where we were last year. And that makes the conundrum for the reinsurers that want to grow is you actually have to show that you've done something or that you are something special, because you need to have those sharp elbows against in a situation where the buyer has 130 points to place or 100 points to place and 130 to choose from.
So if we're talking about tides and peaks and tailoring metaphors, Charlie seems to be seeing a peak in momentum, but one at where the price can still stay up close to the high water mark. So not quite bespoke, but at least more choice on colour and styles. Here's David Flandreau sealing the deal with the numbers.
If you look very closely at capital levels, and we measure dedicated reinsurance capital, as you know, very carefully, you can see that it's finely balanced with risk if you measure risk as premium. And I guess when you're looking at large numbers, this is a reasonable proxy. Most of the premium increase that we've had over the last year or more has come from price. In fact, decidedly not from exposure. So yeah, I think it's pretty difficult to continue to increase price in an environment where capital and risk are finely balanced, but capital has come back, and also in an environment where lots of excess economic profits are being generated. It's just a different discussion for reinsurers vis-a-vis cedants than it was last year.
Let's agree that pricing has probably peaked, and that reinsurers are going to have to trade more intelligently and offer more choice. Is that what buyers are expecting? And if so, what do they want to do with their newfound choice? Here's Martin Burke with his reinsurance buyer's hat on, fleshing this theme out.
In 2025, I would hope that conversation about the options that I would expect us to have as a business should be broadening out. So that increase in optionality as to what we might buy and what structure it might have should give us scope to move to a better value product.
Yeah. And so, yes, a slightly more competitive market.
But I suppose to go back a step, having said all of that, I suppose the word of Monte Carlo last year was definitely orderly. I would say, in my mind, the word that I'm starting to use to describe the conference is actually building resilience into the insurer's book by the action of reinsurers. So I think reinsurers are basically going to be helping to put resilience into the system. And that will mean that maybe there needs to be some shift between insurers and reinsurers in terms of the product offering and how those books fit together.
First of all, kudos to Martin for clearly having listened to last year's State of Reinsurance podcast and having picked up on orderly being the word of the rendezvous. Martin mentions value, optionality, and reinsurers helping with resilience. Let's get into detail about what that means in practice. Here's Waleed Jabsheh with more specifics.
Where I think clients will push hardest, probably on the retention side, because just to go back to the comment about the attritional cat, it's hurting the retentions. And those that are hurting most are those smaller regional players that don't have necessarily the capital, the large balance sheets to be able to sustain an environment like this. But at the same time, I don't see reinsurers reducing those retentions, so they start paying more of those losses themselves. I think that's going to probably be the area of friction.
It's almost this kind of like a hot potato saying, well, we would like to reduce our retention, but the reinsurer saying, well, I really don't want that hot potato. I think you need to do something on your own inwards insurance book. You have to change the way you underwrite this.
And listen, we see it across various parts of the world, various markets. You increase retentions to your clients, it instills underwriting discipline. Because it can't be the reinsurer simply taking the risk or the majority of the risk and the client or the cedant relying on that risk. The cedant must have skin in the game. It keeps the minds focused, it keeps the underwriting disciplined, and this way keeps the interests aligned.
So there's no desire to go back to the old days where reinsurers were heavily subsidising cedants so that cedants didn't have to think about a rising tide of attritional primary and secondary cat activity. Or perhaps, as Richard Brindle put it in episode 226, which I highly recommend you listen to as part of any reinsurance prep this year.
We absolutely will never drop back into the maelstrom of attrition. We're not doing that.
No one ever says it more clearly and concisely than Richard. That episode is a must listen. Here's some reinforcement from Jill Beggs and then Simon Bird, Group Executive Underwriter and Active Underwriter at Syndicate 2988 at Reinsurance.
Our main objective is really to cover perils that are away from the secondary perils. So the primary perils in major markets, because we think that we can get the proper return after a loss for those events. And we don't want to be involved in a frequency of smaller events. That's why the attachment points have come up. That, for our portfolio, will continue. We'll continue with that strategy.
Think there is any place for aggregate type covers, frequency type covers? Would you be able to entertain those, or would you simply say they're not on offer?
So for our appetite, that hasn't changed over the past couple of years. We removed ourselves from a lot of those covers, and our appetite hasn't changed. It's been pretty consistent from that point on. We want to be deploying our capacity where there are the major events, so the hurricanes, the earthquake types events, where there is a payback afterwards. It's more of a market event as opposed to smaller events that are eating away at our earnings and can be retained by our clients.
Recalling conversations of 2 years ago, the increase in attachment points has absolutely vindicated the reinsurer's approach there. So many small attritional cats, if you like, have been now self-retained by insurers, which is, I think, correct. It's for the original insurers to price in a reasonable attritional cat margin and just leave the reinsurance community for the sort of middle to large, much more named storm type losses and so forth, and not pick up what I might rather crudely describe as dirty little cats or something like that. That's not what reinsurance capital is here for. That's something that the original insurer needs to price for.
So the message is clear, but surely something has to give. And let's not forget that many buyers of reinsurance have been remediating their inwards books for almost 5 years already. Could now be the time that they start to get a bit of credit for the work that they've done. After all, if an underlying book has priced in a lot of attritional cat and become less volatile via diversification, limit reduction, and increases in original deductibles, surely some reinsurers will be happy to help a little in exceptional years, even if the trend is still rising. We're going to get some views on that later, but first, here's a longer and more nuanced exchange with Paul Brand, CEO of Convex. Paul really sees both sides. We must never forget that earnings cover is a nice to have, when compared to the fundamental balance sheet protection that is at times much more existential.
What used to be earnings protection for some of those insurers slipped into not earnings protection because it wasn't covering any sort of volatility. It was just essentially a subsidy because it was 100% almost certain that the reinsurer was going to lose.
So if solutions that are out of the money, and palpably out of the money with a bit of space, buffer, do you think they're likely to be got away?
I'd be surprised if you don't start to see the market innovate. Now, if you go back to the precise circumstances of when it sort of hit the buffers at the end of 2022, the thing that really caused that, and I can remember being at Monte Carlo, and everybody was going to say, the market's going to change, but it's going to be reasonably measured. And then I was at CIAB, which was post-Ian, and everybody was running around with their hair on fire going, we've had enough. And so at that point in time, the broker's job is to try and assemble as much capacity to meet the key needs of their clients, because capacity is just drained out of the market really fast. And at that point in time, the buyer of the reinsurance product is really lovely if you can get earnings protection. But the key thing you need is balance sheet protection, because if you have another really bad year, it's not the earnings protection that keeps you in business, it's the actual balance sheet protection. And so most companies were, and Convex buys a lot of reinsurance as well as sells a lot of reinsurance. And so we were actually very happy with the way, I'm not saying I was happy with the prices, but we were actually very happy with our ability to actually get the necessary balance sheet protection so that we could actually offer both our insurance and our reinsurance clients continuity as we traded into 2023. And it was entirely possible that 2023 could have been a really bad year for those reinsurers as well. And it was really valuable cover. And the story that we couldn't buy is not really true. Now, if things settle down and we had a long period where actually the losses are broadly what we expect and everybody starts to feel a bit more confident, then I agree with you. You'll start to see earnings protection and more discretionary coverages come back. And the brokers are always ever inventing and reinventing and innovating onto how those structures could be made to work. And we'll be open to those discussions.
Paul really putting things into proper context. If results are good and confidence returns, the market will probably come back for nicer to have covers over time. And here's another long exchange, this time with John Kavanagh, Chairman and co-founder of Lloyd's carrier Beat Capital.
Our plan next year is to lean less on reinsurance if we can and try and manage our own net within our own resources. And what we haven't seen of late is the large vertical loss that we've all been reinsuring for. What we have seen is a whole bunch of frequency where you can't buy anywhere near enough reinsurance to deal with that at the level you need to. So would I say our reinsurance has performed as a benefit? No. It's performed as a backstop protector if we needed it, but we haven't needed it. So it's been an expense, obviously, which it always should be. I mean, your reinsurer should always make some money from the trade. But I think since we've been buying reinsurance, we've never really leaned on what we buy to the extent that we could or should.
I suppose it's fingers crossed that we never have to.
Well, quite. There's no arbitrage opportunities around, really. No. And there's not really been...
But not even with arbitrage. Just a fairly priced product that makes sense, to protect a very severe frequency year.
Yeah, I mean, those types of things just haven't been available. I mean, we'd love to buy those types of things.
Yeah, but do you think now that we have a market that's regained its confidence, that has reset, that say, well, yeah, I think we understand this. We know it's a moving target. It's a bit like casualty. We know, given that the frequency is still increasing, you can't really argue that it should be cheap.
No, of course not.
You can say, well, yeah, but at the right price, at a probability level that makes some kind of sense, that there should be something that's just a bit of a stop-loss type situation that the buyer could find value in, and that the seller could see it's not just some giveaway.
Yeah, so I totally agree with that. If we could find, not cheap reinsurance, because that's just not available at the moment, but fairly priced reinsurance that gave us some earnings protection, either by means of multi-year aggregate excess of loss or multi-year stop loss or even one-year stop loss that picked up, because we're a very diverse syndicate now. Yeah, we've got 11 businesses going into the pot and very low severity cat. So we've got a nice balanced book ourselves. Now, what that does is make you want to lean on that balance more heavily in a market where you can't buy cost-effective reinsurance. Yes. Not cheap, cost-effective.
Reinsurance is an essential form of capital for balance sheet protection, but the lower down you go, the less essential it becomes. You don't have to buy it if you feel you can manage your net well enough on your own. Wally Jubshire said earlier that increased retentions instill cedant discipline and align interests. But here's the logical comeback to that from John. If you force me to clean house, I might quite like to stay in it, especially if I feel that the interests are aligning too much in my reinsurer's favour. And there's clearly demand for something that meets somewhere in the middle. So if reinsurers don't negotiate, they may find some cedants buying less and relying on their own underwriting skill and diversification. Logically, what else might give? Here's Simon Bird, highlighting that pressure on top layers is already being felt. After all, if most reinsurers still want to be way in excess of something attritional, if they don't help out on cedant pain points elsewhere, they might get signed down.
Property cat is adequately supplied. We've seen some pricing pressure more at the top because obviously minimum rates online and so forth, but the expected loss is that much lower at the top, so the perceived margin is greater, and there probably has been a degree of concession up there. But I don't see anyone being aggressive at the bottom end of programs. People are still fairly nervous at the entry level.
But is this the trade this year? To say, I have to give something that I probably don't want in order to get something I really do want, so I don't get signed down on those top layers that I quite like.
Yes, but I think it's still, the very bottom end is still quite finely poised. I mean, if you look at the sort of first layer, it's kind of 15 online, that sort of number. If you're going to lower that attachment point and just think for a moment critical cat only, name windstorm or whatever, so something underneath that layer is now 25 online, then you throw in the secondary perils as the cliche is at the moment, flood,
just more perils.
Non-modelled risk, blah, blah, blah. Suddenly, 25 is now comfortably north of 30. Well, I don't see who's going to buy that. You've got to stand back a loss. If we're going to do something, in inverted commas, useful, but still prudent and safe and reasonable as in risk transfer, then you've probably got to stand back a loss.
Simon also recognising that there might be a solution somewhere lower down, protecting earnings to an extent, but doing so out of the money. That is to say, with the benefit of a buffer. And here's John Welch, who agrees that there are deals to be done, as long as they're out of the money. He's followed by a brokerly view from Craig Darling.
I talk to some people and they'll say, look, we're never going back into that world again. We're never going back into the ag kind of world, that frequency removal world. But others will say, well, yes, actually at the right terms. And obviously if it's genuinely exceptional frequency, I just don't want to be into the day-to-day frequency, which is, it doesn't make any sense, money swapping and all that.
Yeah.
But when they say, normally they have 2 cats a quarter, or whatever it is these days, if I'm in excess of 4, I don't feel so bad being there. And I think I'm there for a good reason, and with something genuinely exceptional has happened.
I think there's definitely room for that, and we write a couple of those now where it's well out of the money. It's for real severe volatility, unexpected. I absolutely think there's be a market for that. Yep.
I think you're going to see improved terms and conditions because when you start doing year-over-year results that are improving, the trend lines are improving, they've been able to get additional original rate. All of that will make the profitability more obvious to the reinsurers, and that means that they're willing to give a little bit more sideways protection, as well as getting better ceding commission schemes, which obviously makes the placement, the structuring of the placement, much more effective for the health of the company, as well as the fact that they feel like they're assured by taking that risk at very low levels inside the 10-year return time, 5-year return time, they have a very good chance of making profit. So I think that has moved dramatically, certainly in the property spot over the last renewal cycle. 2024 versus 2023, a big move.
So at 1/1/25, we should be expecting smart trades to happen somewhere around this theme. Smart buyers and smart sellers are going to coalesce somewhere where they both might continue to be happy. Here's Scott Egan, CEO of SiriusPoint, with some really well-rounded thoughts to close this subject off.
I've always been a buyer of what I would term frequency cover. And I actually think on the insurance side, that is something that has real value. I think what we're talking, though, is how can we design the product in a way where both sides understand the cost of the product, the features of the product, and how it will work, as opposed to, I think, what you were alluding to, this year I win, you lose, next year you lose, and that, I think, is where it falls down. So I do think, is there a space in the marketplace for the industry to think more creatively? And listen, that might not be me, that might be people who are much more intelligent than me around product design and how that might work. But I do think the industry needs to stare hard, working alongside the insurers, at what frequency protection might look like, how we should price it. I think there's also a behavioural dimension, which is just both sides acknowledging that actually the answer's somewhere in the middle, as opposed to hitting the ball back over one side of the net. And I think if we meet at the net and shake hands, using my tennis analogy, I think that would be a much better place to have a constructive discussion.
So there you have it. This is the first big reinsurance trade of the renewal. Get involved with removing some of your best customers' pain points, or you might lose out on growth. And it's not necessarily about price. It's potentially just as much about attitude and having a willingness to invest in relationships and to differentiate where it makes most sense to do so. Here's Charlie Goldie.
As a buyer from January of 2023 or December 2022, the scars are still there. And so you remember who treated you well. You remember what situations you were in that you wish you hadn't been in or hadn't gotten into, and want to work with some folks that are a bit more stable in how they react to changes in the market. There's an important role for the transactional one-year market, but I think the best reinsurance situation is where you're looking out over a 2, 3, 4-year window, saying, what are you trying to do? What are we trying to do? These things match up. Let's try and work together to get where we're going.
So relationships are starting to come back into prominence again, and smart reinsurers are realising this. Now it's time to talk about the other big theme of Monte Carlo this year. This was the casualty market, and in particular, the US casualty market, and even more specifically, the US general liability insurance and reinsurance market. The longer the tail, the greater the debate. So casualty is always debatable, even at the best of times. But given heightened loss trends and some recent recognition of reserve inadequacy for prior years, it's particularly debatable now. Here's a long exchange with Jill Beggs. Everest has been in the casualty reinsurance market as long as anyone, as well as playing in the insurance market too. So I think this is a really good starting point.
Casualty is the tale of two markets. Internationally, we feel pretty good about where we're at. We've been growing with clients across all lines, and casualty included in that. But in the US, we're seeing elevated loss trends. It's driven by social inflation, legal system abuse, more active plaintiff bar, litigation financing companies, and that is elevating costs in society, and insurance isn't immune from that. So it's a challenge for us. And because of that, we expect rates to continue to increase on the primary side. A lot of our business is proportional. And so we do expect that rates will stay ahead of loss trend, and loss trends are increasing. So rates need to continue to go up. And on the reinsurance side, we need to see an alignment of interests, which typically means lowering ceding commissions. Again, it's not across the board, but there are those programs where if we can't get that alignment of interest, we would pull back. So we are concerned about casualty. And I don't know if the market is aligned in the thinking across the board.
What about current business being put on the books today? Presumably it's in not a bad place.
So rates have come up, limits have come down on the primary side, and I think that's all positive. I think that that's a really positive movement in the marketplace.
And where the economics are that we're finally getting back to sort of old-fashioned real interest rates, more or less, which we haven't had for 20 years.
That's right. That's right. Yeah. We are still seeing the loss trends on even the smaller limits, and the rate increases are great. What the conversations we're having with clients are around really differentiating their portfolio against what we use as industry benchmarks, which isn't adequate for any company. So we're really digging into the specifics of their portfolio, asking for more detailed information and renewal packages earlier. So we do have time to have those conversations, but we really want to understand the nuances of that portfolio versus the others and really make sure that the terms and conditions are appropriate for that client.
That was a really useful primer. Now's a great time to hear from Vince Tizio, CEO of Axis Capital, another expert casualty market player, both in insurance and reinsurance.
You know, we're a company that undertook a reserve charge in the fourth quarter of 2023 and painfully went through a process carefully looking at our exposures. And as you know, the liability book was the principal component of that charge. And so we have great experience, and our reinsurance team is infused with the same skills and capabilities that are giving rise to our confidence in our own company's loss reserves. And so we're just taking a very steady, consistent, and disciplined course.
Is it a question of you know what's in front of you, and then therefore you know what's going to fit, what you want to underwrite and what you don't want to underwrite, and you're certain of where your price should be?
The clarity of our underwriting appetite is certainly in hand. The pricing that accounts for our belief around how trend and our cedants portfolio will develop is informed. Of course, there's a degree of cautiousness, of course, but we still are providing a fairly disciplined offering in liability reinsurance. To date, candidly, this portfolio has grown really through rate achievement, not exposure growth, and so we'll maintain a fairly cautious eye on liability.
Lots of candor from Vince. So, with incumbents sounding a note of caution, and justifiably so, it looks like there may be opportunities for those looking to increase exposure in the right areas. Let's get a global view of the numbers from David Flandreau.
Now, what we're seeing when we look back at accident years 14 to 19, or maybe 13 to 19, if you look at the U.S. Schedule P at other liability occurrence and other liability claims made, not least reinsurance general liability and commercial auto liability, if you look at those lines of business, and again, I'm looking at this from the top down as an analyst, you can see the deficiencies coming through in 14 to 19. And that really is what a lot of people are heavily focused on when you start talking about social inflation, litigation financing, jury awards. It's those other liability lines on the Schedule P that are really coming to the fore. So that's important, and I want to acknowledge it. The thing is, if you look at the entirety of the Schedule P and you include comp and you include short tail, the net deficiencies for 2023 were about $1 billion. That was on about $900 billion of total Schedule P. Now, I know that bad years get worse, and so we're all wary of that. But if you look at calendar year, and if you zoom out and you look worldwide, you will see that the last time we were net deficient on a calendar year basis was 2016. Even in 2023, even in the first half of 2024, in aggregate, we're still releasing. That might change. And I think that what we're coming to terms with as an industry is that the reserving cycle is a cycle. Everything will not always be redundant, as much as we'd like it to be. We go through these cycles, and we can actually measure them going back to the 1930s, in the U.S. anyway. And I just think that we're in a part of the cycle where we've realized that some of the older accident years were under-reserved. We have strengthened reserves on those accident years, but the net result of that is nothing like what it was in the liability crisis of the early 2000s. It's a completely different picture. So it is one factor, and it's clearly important for people that are placing casualty business. It's just that when you zoom out and look at the entire global reserve picture, if you add up all the reserve movements of all the major carriers, you pick any 20 major carriers or 30 major carriers in the first half, you're still looking at net redundancies, and to some extent. So I think that it's TBD, but it obviously creates risk premium, and it means that cedants are having a different discussion, reinsurers have different concerns, and it's our job to make sure that those are assuaged and mitigated, and it really is book by book.
Of course, TBD stands for to be decided. Fascinating stuff from David, as ever. There have been bad parts, but to put this underperformance in context, this is nothing like the crises of the early 2000s or the late 1980s. So this perhaps bodes well for prospective new entrants. We'll get to that soon, but it's worth checking in for an overview with James Vickers before we do that.
You're hearing a lot of reinsurers saying they want to ease back on their US casualty. The fact is, they want to write it because they know it's a diversifier. The question is, what are the terms and conditions they're going to get it at, and are they comfortable with all the litigation funding, the social inflation increases, that the original business is being priced and structured to cope with that? And provided that the ceding company can explain that, reinsurers are prepared to support them. They don't want to shed large slugs of income, but equally, if they're not convinced, they are quite prepared, the big ones, to just walk away. They don't want to put premium on the books where they don't think they can make an underwriting profit over time.
How much are reinsurers' emotions swayed by their past results?
Well, I think their emotions are considerably swayed by their past results. I mean, there are those who are relatively new who don't have much of a tail. They're looking at and pricing the business differently to those who unfortunately did write business have got a reserving challenge on their back years, of course they're going to look at it in a slightly different way. But since we're talking about, at the end of the day, it's things like people's views on social inflation, that's a very, very subjective view. It's not like some of the property cat stuff where you can use cat models and there's a general understanding. People will take different opinions and they will look at it differently. So we clearly believe that a number of major buyers of US casualty, they have a very good story to tell, and they should and will be able to renew their programs at reasonable terms, and the reinsurers will be happy to support them. Equally, we're realistic. There are some people who are going to find it quite challenging, even if the terms that they put forward on their underwriting business looks more attractive for 1/1/25 than it was in the last couple of years.
Great insights from James as ever. There's a subtle but important difference between a reinsurer who's ready to be convinced to do something and one who is minded to drop a class and needs talking around. The point about a miss factor on the losses is as pertinent as ever. There's also additional uncertainty over how the COVID shutdown and subsequent reopening affected the legal system and how it sets awards. Here are some really interesting thoughts from James Slaughter.
I think the industry, myself included, 3 or 4 years ago, was overly optimistic about where the post-COVID landscape had landed. And if we've got that wrong, we've started off the wrong start point. And so therefore we are constantly drifting. And I think in results that I'm looking at and what limited but reasonable access to the market information that I have, I think as an industry we've got to be super cautious now. I think it's very plausible that we've underclubbed as an industry. The bounce back post-COVID, the legal inflationary factors are more dramatic, I think, than we might have anticipated. And the need for people to reach quicker resolution to complex issues suggests that both the severity, the frequency, and the speed of settlement are dramatically different today than they were 2 or 3 years ago. The knock-on effect of that is I think casualty reinsurance is a more complex story. It's likely that we'll see reasonable rate, I think, in the primary market, the underlying market, through the next year. With my ethical hat on, I worry about companies like a straightforward Midwestern manufacturer of non-complex products struggling to find $100 million of GL because of the nature of the liability market, and it echoes 85, 86, 87 type things, which I would consider to be a really bad outcome for our industry and the economy in general. Probably the counterpoint, which is worth always challenging your own perspective with, is it's still profitable, right? This is not 99 or 98, where losses were running in the 100 plus range. What it is, though, is somewhat of a shift in how the pattern of liability, I think, plays out.
Interesting that even in a relatively downbeat assessment from James, there's also a positive recognition that there's still profit to be had in this market. This is a vibrant market, so let's hear some other views without me interrupting. I first asked Peter Wilkie if new capital would be welcome in casualty. Then we hear from Craig Darling, and then Alex Maloney, and end with John Kavanagh, who, given so many formative years at casualty reinsurance broking powerhouse RK Carville, is always worth hearing from on this topic.
Yeah, I think you would. And I think that will be interesting if new capital comes into the market as well, how they view it, because you can get on some casualty quota shares, get a lot of premium in the door pretty quickly, and you're not worrying about legacy issues. So yes, I think that there definitely is potential for those markets coming into it fresh to be looking at it very differently and not having to have that reserving issue.
I think that if you're coming in and you have the right balance sheet, your right kind of commitment, the right kind of capacity, I think there's a way to carve yourself onto a program that you probably would not have been able to get on 2 years ago on the casualty side. Probably still holds true even on the property side, but certainly on the casualty side, I sense there's a little more dislocation, and each line is not the same. But again, as I said, the wheels business is very complicated right now. If you came in to support, you'd write what you wanted to write at pretty much at what you want that price to be.
You would make lots of friends.
There'd be a lot of people kind of trying to court you, I'll just say it that way.
So you'd be paying for the drinks, wouldn't you, Craig?
And a bunch of dinners.
I think that's the problem with any class of business. I think if you have poor results in any class of business, maybe it's just a human thing. It's very hard to back yourself, double down, and that's why the cycle is the cycle, isn't it? You see poor underwriting results, and then people go risk off at the time they should probably go risk on. So yes, if you're me, it's much easier to go into the casualty market because we don't have the bad years, but you do have to force yourself to make sure you're brave when you need to be brave. Let's be honest, what we do shouldn't be wildly complicated, but it's much easier saying what you should do and actually deploying that strategy long term.
There's always an emotion around deterioration over a period of years in casualty, and obviously it creeps up on people. It's not like the property market where the damage is evident. This is over a 5 or 6 year period. You see deterioration on 5 or 6 years of account, and it comes 5 or 6 years after the fact. So, it rolls up collectively as a real problem. And it does become an emotional problem. It sometimes overrides where you genuinely believe rate adequacy is. You can look at price adequate business and say, well, that's all fine and dandy, but I've got this 5-year deficit sitting there now that I need to address. So emotion does cloud it, and these things, one hopes, are looked at in the spirit of the relationship. And if I was a buyer, as I am, as we are, and we did some material damage over 5 or 6 years to our reinsurers, then obviously one would sit there and recognise the impact of that somehow. Now, I don't know how that would manifest itself. It's a sort of deal-by-deal thing, really. But I do think emotionally people will be looking for some recompense or recognition for the damage that's been done in those years.
Yeah, old-fashioned payback.
Yeah, of course.
I suppose, does that explain some of the difference in levels of appetite? Some people have that miss factor. They weren't really in the market, or they were less materially in the market back then, and therefore feeling quite good about themselves and thinking, I quite like this rate adequate business. I might do a bit more of it.
Yeah, well, we're kind of in that boat. We weren't around then, know. So this is all good stuff for us. We're not suffering the vagaries of those bad years yet, and we're enjoying the benefits of an improving market. But I mean, that's just more luck than judgment, really. That's timing and luck.
Yeah. But in terms of you feel it is rate adequate, because obviously this is a moving target. It has to be whatever plus something every year just to stand still. So are you feeling you're getting it?
Certainly on the insurance side, we feel as though since we've been going, really, since 2018, 2019, we feel that it's been very rate adequate in every line of business we've been in.
I hope you've got your breath back. On this showing, it looks like Craig's casualty colleagues should be inviting Alex and John out to dinner. Let's see if we can find any more dinner partners for Craig and his wider team. Here's John Welch and then Martin Burke.
I think you can get distracted by that, right? So I've been in enough organizations where you spend all your time looking backwards and doing deep dives and getting distracted by what's happened in the past, and it can prevent you from making a good decision going forward. We certainly want to use all the data. Thankfully, it wasn't our losses necessarily. Use that data to kind of inform how we're thinking about it, but not be afraid to kind of lean in when there is an opportunity. That is an area we are growing in. I'd say our history is to be relatively light in that area. So thankfully, we don't have a lot of problems from the past affecting our results. And again, I get back to the folks that we want to back in that regard are the ones that I think are very good analytically, are on top of their rating, they're on top of their loss trend assumptions, and they're people that handle claims well and we want to continue to partner with. Yeah.
So you're cautiously confident that you can step forward there?
Cautiously, yeah. It's exactly the right word.
Part of our strategy has been to balance up our own portfolio, and that has involved focusing more on some of the longer tail lines and emphasizing less growth in some of our property cat exposed lines. And as part of that, we are looking to extend our repertoire, I suppose you could say, in casualty reinsurance. We have a team that we have full confidence in who've delivered very good results for the business, and now is the time when we feel like there's a good breadth of opportunities that team can avail of. So we're aware of thematic market issues such as social inflation or back year, accident year deteriorations that we've seen in prior years. But our approach to that has been careful risk selection in terms of our underwriting, and as we look to take that business forward.
Looks like 2 more on Craig's dining invite list. But I couldn't end a segment on casualty without calling on the long experience of Simon Bird. Here's what he had to say.
Dial the clock back 2 or 3 years ago, then US casualty pro rata was sort of flavour of the month. The perceived margins on the original business were seen as strong, line size compression, original re-underwriting, etc., etc. All of that augured well, and tolerable ceding commissions. And people almost preferred that to risk excess or excess of loss or whatever. But now we've seen still a continuing back year development in financial year terms on the sort of bad years of 14 to 19. Initial prognoses on 2021 still showing above average frequency. Obviously, they're not yet developed, but the portents are poor, actually. People are really concerned. So there's constant need to see original rate. Now, that's fine in the E&S market where you've got freedom. If you're admitted, there's less room for maneuver. And if you're a reinsurer, particularly with a legacy issue from those older years, 1 point off the seed is not really going to cut it, is it? We have this legacy issue in the market, and there are younger, newer reinsurers out there who don't necessarily, they're not looking over their shoulders concerned at what's coming from those older years because they weren't around at the time. But they don't make up the whole market. They actually only make up a fraction of the market. When you look at the big guns, the big Europeans and so on, and we're hearing from 4 or 5 major reinsurers here, they've all got their concerns about GL and US bodily injury, cost thereof, if you like. If they practice what they're presently preaching, then they're going to be taking hundreds of millions of premium out of the market because they're going to be cutting back. And there is no way that that new, younger sort of cohort of reinsurers will be able to soak it all up. The volume's too great. Casualty reinsurance is, you don't come on for a year, come off for a year, and hope to get back on again. You can't just flip-flop. Casualty is always seen as a long-term loyalty.
So it sounds like there's an opportunity there for clean capital.
Clean capital, yes, but you've got to have pedigree in the personnel.
Wise words. Yes, there's an opportunity, particularly if the biggest reinsurers exit the market in any meaningful way. But you're going to need the right kind of balance sheet, the right rating, the right pedigree of underwriters, and the right kind of attitude to access it. It's time to start wrapping up. One of the old chestnuts we probably need to roast quickly before closing off is the perennial question of whether new capital is likely to enter the sector in the form of startups. As in 2023, stories of new company formation were circulating, but there were stories about the same companies as last year. Here's Richard Brindle, who, given Fidelis' relative closeness to the capital markets, is a very knowledgeable source.
I think the ultimate indication of where the future path of travel is that there's no new capital coming in. And we speak to bankers, lawyers, rating agencies all the time, and there are no new cat companies coming in. There's some froth in the news here at the moment, but whether that's going to turn into anything tangible is another matter. But that's the ultimate arbiter, and we have increased demand, and we have static, maybe retained earnings are contributing towards a modest increase in supply. But to us, the equation is broadly in equilibrium.
Last year, Richard said the chances of new capital formation were a big fat 0, and this year nothing seems to have changed. Here are 2 really revealing exchanges. The first is with Scott Egan, and the second is with Alex Maloney.
We've had a few years of good returns. If you analyse why, number one, particularly in property cat, there was market corrections, but also in other lines we were carrying rate. But number two, particularly in the property cat space, for big events, it's been a benign, and I'm going to touch wood as I speak to you, it's been a benign period. So I don't think you can look at the absolute levels of profitability and say, wow, that's really attractive, let's pile in. And then I think there's a behavioural side to it, Mark, which is, I've seen many headlines coming into the conference and whether rates are going to soften and whatever. Honestly, I think if you're looking at investing in the reinsurance sector and after a few quarters or 2 years and a market correction, immediately the rates start to come off just because we've had a few years of no big events, that doesn't make for a strong investment thesis, in my view. So I think investors are being wary, and candidly, I think they're right.
No entity is formed until it's formed. This time last year, we thought some of these entities were going to be up and running, and they weren't. And until we have confirmation that the capital has been raised and these guys have a rating and the appropriate people, it's very hard to say. I think investors are looking for evidence that balance sheet businesses are sustainable, and that means track record and results. So the industry's had another good year, so there is more evidence. Now, if you're an underwriter, you could say these guys should have backed vehicles 2 years ago and why they're coming in now. But just the simple 5-year return will look better. The margins look better. There's more evidence. So maybe these things will happen in the next few months.
It's not your money and you do it when you can.
You can only raise capital when the capital is available, can't you? You know, it doesn't matter how good you think your idea is. If the capital markets are not interested for whatever reason that is, you just can't do it.
If that capital was raised, would it change the market much?
I do not keep awake at night worrying about new startups. If you look at the capital that will be generated by the existing players in the market in a great year, that's much more troubling.
Retained profit is huge.
Retained profit will be huge. As you know, we pay a lot of our profit back to shareholders. That gives you good financial discipline. So the fear will be, what does everyone do if they make a lot of money this year? And generally, that creates more competition.
Do you think that might make the other thing that tends to happen at that point is that M&A starts to become more favourable?
I think that is guaranteed. I just can't tell you when it's going to happen. So I think...
Well, obviously it depends on the weather and all sorts of things,
exactly.
doesn't it?
So my general rule is the more money the industry makes, the quicker it softens, the quicker M&A starts. There are a number of businesses, maybe more than we've seen historically, that are privately owned, that have owners that have owned those businesses for probably 5 years or so, and they're coming to the end of their natural investment period. And some of those management teams are, dare I say, the wrong side of 60. So they're probably looking to, I don't know, maybe come to Monte Carlo and enjoy Monte Carlo when the conference is not on. So I think there's a number of businesses. I think that's going to happen. I would expect someone to fire the starting gun maybe Q1, Q2 next year.
So investors are rightly wary. Startup capital is likely to be dwarfed by retained profits, and in that case, M&A is probably more likely than new company formation. Let's let Paul Brand have the last word on this. Paul's always an original thinker, and last year you might remember him describing the state of the market as brittle. I opened by asking him if he thought the market was less brittle than it was a year ago.
I remember you said that the market was quite brittle last year. Is it less brittle now?
No, I think it is.
It wouldn't take much to shatter it on the floor.
Absolutely. There's an awful lot of companies out there who are struggling with their investors, whether that's publicly, and you can see that in share prices, or whether that's privately and people are seeking exits and aren't entirely certain where those are going. There's not a huge sense when you speak to the investor community that the carrier part of this industry is particularly attractive. If you speak to them about making investments into brokers or MGAs or capital light models, that's much more interesting for them. But at the end of the day, for the insurance industry to work, you've got to have somebody who's prepared to take the risk. And those people have to be able to satisfy their shareholders over time. We've not done that. That case is not proven by a good year in 2023.
Sobering and measured thoughts as always from Paul. So that's it for another year. The market is definitely on the road to recovery, and I hope this short documentary has shown a far more colourful variety of appetites and preferences on display from reinsurers than this time last year. But as always, the weather is the big caveat. Another medium or large size property reinsurance loss and talk of accommodation is likely to be put on hold for another year. Similarly, in casualty, any significant changes in the appetites of the largest reinsurers and insurers can cause outsized effects in the marketplace. I once again thank our sponsors, Stevens Rickard, and wish you a successful and stress-free 1/1 renewal season. Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this programme. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you know you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry. Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.